Welcome to our Ask an Expert show, where I invite a fellow professional in the cross-border space to come in and talk to me about the issues we think international folk in America need to be aware of if they are going to thrive here. My guest today is Brian Dunhill. Brian is the founder at Dunhill Financial, a cross-border financial planning and wealth management firm based in London, and he is a financial planner dedicated to assisting Americans living abroad and expats in the United States. Brian is an American living in London, and full disclosure, our firms do have a formal relationship. We will sometimes introduce clients to Dunhill when we think they would be better served by Brian and his team. We know what we're good at, we know what they're better at, and sometimes it's in the best interest of the client, as hard as it is for us to say goodbye. So anyway, Brian is here today to talk about PFICs, the humble yet dreaded PFIC, which gets so many expats in the US and Americans abroad into trouble, whilst also severely limiting what Americans outside the US can invest in. So without further ado, let's get into this. Hi, Brian. Welcome to We're the Brits in America podcast.
Thanks so much for having me, Richard. Always good to see you.
Likewise.
You're going to put us right into the territory of a four-letter acronym. So, just like any 4 letters that Mama told you about, you shouldn't be owning these as Americans or as Brits moving into America. And I'm sure you tell every single one of your clients the same thing. Maybe not so crudely.
We get to them too late. That's the problem, right? Part of this, the mission of this podcast is to hopefully help prepare rather than repair. But usually, let's be clear, by the time you and I see this problem, it's a case of repair first.
Absolutely. Anytime you can get somebody to clean up their portfolios before they get to the States, it's going to be so much easier for them and so much cheaper from a tax perspective and even from a tax preparation perspective. So the key is, have the conversation with Richard before you get over to the United States. He'll clean up the entire situation.
If only that was more frequent. I'm obviously thinking about people leaving the UK. People speaking to someone like us or speaking to a tax advisor, but no one does, because I don't think it's just a case of cost. I just think people just are utterly naive, as was I, to the complexity of moving to America specifically. And it catches so many people, the vast majority. But look, Brian, before we get into the details, just quickly tell us, in your own words, who you are and how you ended up in this unfortunate position sat here talking to me.
Well, thank you, Richard. Essentially, my name's Brian Dunhill. I run a firm here in Wimbledon in the United Kingdom, which is on the southwest side of London, where the tennis courts are, just down the street. And we concentrate only on American expats. We concentrate on them all across the world. And we have a lot of clients that are British Americans that are here in a mixed family type of relationship. And that's where we've stumbled into Richard, because he does the exact opposite. You're working with Brits that are in America. We're working with Americans that are in Britain. So basically, we get to take the inverse image of pretty much each other's situations. And we get to enjoy each other's company in understanding that we deal with the same problems, just on opposite sides.
It's the mirror image. It's quite it's an interesting space to be in, and it's been great to find someone doing the exact opposite, and then comparing notes and swapping war stories and having someone to go to with questions. And like when our clients do leave and they end up in a jurisdiction where we're not familiar with, have someone to turn to.
And same vice versa. We occasionally have people going back to the States.
And
it becomes more simplistic to have somebody in the same time zone, i.e. being able to pick the phone up and not be calling somebody in the middle of the night. And for those those people that are moving to America, it's also nicer to have somebody that's on the ground and working just in the American products instead of us working on UK products with the mix of the old US products.
Just tell us quickly, how did you end up where you are now? Like, what's the journey for Brian been?
Well, there's an old expression that anytime a sentence has 5 words in it, when you've had a couple of beers, it's probably a bad idea. Starting with, we should have another drink. But mine ended up on a sailboat with my father down in Turkey. And the saying after a couple of beers turned into, we should start a company. I'd finished off my MBA over at the University of San Francisco. I was working for UBS at the time. And essentially, after finishing my MBA, I decided I wanted a new challenge instead of working for just the big banks. This was just shortly after the financial crisis. My father's firm had been just purchased by a bigger UK firm there in Belgium. and he had a series of different clients in Belgium. And it came up. Both of us would like to work on something bigger moving forward, so we should start a company. Those 5 words turned into, oh my goodness, FATCA just got approved. FATCA was back in 2011 by Obama, and it essentially made all of these things that we're talking about, FBARs, citizens-based taxation, PFICs, very easy for the American government to uncover. So things that people had been doing as American expats for years, for decades, all of a sudden became obvious to the U.S. government, to the IRS, to uncover. And so we had millions and millions of Americans abroad that all of a sudden had to adhere to all these rules that had been in place for decades but hadn't really been followed. So that's where everything changed at that FATCA time, and we just happened to start the company right at that time. And we had a U.S. license, we had a Belgian license. Therefore, we were able to help all those individuals on their home territory throughout Europe.
That's amazing. I did not know there was a Dunhill senior involved in this. Is he still involved?
He's a few years elder, so he's
obviously
he's having a little bit more fun in a little bit of a post-retirement phase. So
good for Dunhill senior. Wow, so you started just as for Americans who had been abroad for years at that point, it must have felt like the rug had just been pulled from them. Because then now it's not just like, I imagine it's not just a case of, oh crikey, now we have to do all this stuff. It's also, oh crikey, not only do I have to worry about going forward, but there's a whole load of stuff that I haven't been doing that I should have been doing that maybe I didn't know I should have been doing, and what do I do about all that? So I bet that was a great time to be setting up a business, because what a need for what you do. There's always been a need, but the need just exploded. But also I imagine it was a deeply unsettling time for a lot of Americans abroad.
Absolutely. The majority of Americans that have been abroad for decades had been doing things, buying PFICs with no problem, especially in Belgium, where you have branch 23 and all of a sudden you pay no tax. They hadn't been declaring it to the States because the States had no ability of catching them. All of a sudden, FATCA comes out, and all of those portfolio bonds were saying you have to move your account and you have to do so immediately. So they're calling with a sense of emergency of getting kicked out and having to report it to the U.S. government. It wasn't a fun time for all those Americans, but deeply satisfying to be able to help them find the right track and be able to get their investments set up in the right way that conforms with the rules, both in the U.S., Europe, UK, etc.
Let's get into it. Right. PFICs, Brian. Tell us what I mean by this unpleasant-sounding acronym.
So PFICs are passive foreign investment companies, and it sounds just as dirty when you actually spell out the acronym as when you say the acronym. Long story short, there's a lot of definitions that go into it, but for the majority of retail consumers, what a passive foreign investment company is any foreign collective. So if something looks like a U.S. mutual fund, but it's sold abroad, it will be a PFIC. Even more importantly, if you buy an exchange-traded fund on a foreign exchange, because it's a collective, that's going to be a PFIC. So anytime you're buying investments outside of the United States and they're majority passive, they're going to be a PFIC. And it's going to be taxed horrendously on the U.S. side, even if it's taxed in a decent way on your home territory. And the reporting requirements to them is going to be egregious. And sometimes, most times, I think you'd agree, Richard, almost impossible to be able to calculate. So you're having to make some estimates on how to calculate the taxes that might be due.
It's horrible. So anyone listening, this is not any investment, but any collective investment, pretty much any fund, exchange traded fund, mutual fund, if it's not a US based, and by that we don't mean it invests in the S&P 500. I mean where the fund is domiciled. You're buying the fund in the UK or Europe in pounds or any other currency than dollars, it's almost certainly going to be a PFIC. And they are a horror show if you're a US person. And by that I mean if you're an American abroad, well, any American anywhere, but let's say mostly an American abroad, or as we see it here, an expatriate who's come to the US. So you've come to the US from the UK or wherever, you're mid-career. So by the time you're mid-career, you've built up assets. through years of working, pensions, savings, ISAs in the UK, whatever your equivalent is from your country. These are going to have PFICs in them. And people arrive in the US with them, thinking nothing of it, and then they learn the hard way that these things are taxed punitively, and there's a boatload of reporting requirements that go with it.
Absolutely. And those reporting requirements are typically charged and filed by the fund. So if all of a sudden, if you have a diversified portfolio of 10, 15 funds, you're going to have to do 10 or 15 reports of PFICs. And they're going to charge you per document, per fund. And I've seen some of the accountants charging in excess of $500 or $1,000 per fund, to where it gets extremely expensive.
Have you seen the IRS guidance on how long they estimate it takes to complete the 8621? So 8621 is a form associated with these PFICs. And the IRS, I can't remember what the exact figure is, but we're talking, it's like 10 or 20 hours. It might be even more than that, 20 or 30 hours, which seems a little excessive. But to Brian's point, regardless of whether it's a couple of hours or 20 hours, according to the IRS, an accountant who's going to fill out this complex form is going to charge for it individually. And if you've got a portfolio of PFICs, forget the tax. That's going to be punitive, but the reporting itself is going to be punitive.
It becomes cumbersome, expensive, and annoying. So that's why Richard says, if we can catch this beforehand and not even have to go through the mix, it's going to be the best option.
Even people who are aware of the PFIC problem, so they know to jettison in the UK we call a brokerage account a general investment account, right? So they know to jettison their PFICs before they get here. Well, it still catches these people out because they might be holding PFICs in a wrapper, such as an ISA or an offshore bond, or I'm sure there's all sorts of equivalents from other countries as well. But essentially the US will look right through the wrapper and see that you're holding underlying PFICs. So the thing with an ISA, where this gets so pernicious with an ISA is, we've had clients who have got hundreds of thousands of pounds in an ISA, and they think, well, this is a fantastic wrapper to have, tax-free growth, tax-free withdrawals. I don't want to lose this. So they move to the US and maintain the ISA wrapper, not knowing to switch up the investments within it, thinking they're okay. We come on the scene, we spot it, and we have to say, I'm sorry to say, not only is this now no longer tax-free, but also it's going to be punitively taxed. We always just assume back of an envelope 50%. Once you factor in the tax, the interest, and maybe there's going to be state tax as well, we just like assume 50%. So you thought this was going to be tax-free? No, sorry, it's going to be taxed at 50%. Oh, and by the way, you've also not been filing these forms that you should have done. So now you're also in non-compliance with the IRS. That has flipped it on its head. It's gone from being a great asset to, oh God, what have I got?
And how many of them jump right back on the plane and come back to the UK at that point in time?
Not that many. They more just kind of panic and what am I going to do? Well, first of all, what they do is they get really upset and defensive, which I understand. I really understand it. Because it's completely unfair. It's nonsensical, really. I mean, I understand it now, but it's kind of nonsensical, and people will get very defensive.
It's the 5 stages of grief. The first step is denial.
Denial.
And that is exactly what they're going through, is denial.
Yeah.
You're helping them get all the way down to the 5th step of acceptance, with a big cost, unless they're going to be there for a short-term period, and therefore they're able to push it through.
I mean, what do you do when you do meet someone and you establish early on that they're holding PFICs and this person wants to resolve it? What are the solutions?
For the most part, you have to decide whether you're going to have a slow bleed of those taxable problems and the reporting problems, or whether you're going to go ahead and pull off the Band-Aid all at once. If you're going to pull off the Band-Aid all at once, at least you're going to make your tax situation much easier for the following year. Because you've pulled off the Band-Aid, you've gone ahead and simplified that aspect. The slow bleed aspect is trying to manage it on an annual basis, a little piece at a time, so that essentially you can minimize those taxes each year as you're going, optimizing it over the course of time. Most of the time, the Band-Aid pull is the better way.
Yeah, how do you optimize it though? Because by that point, the elections are not an option for you. So just anyone listening, there are with PFICs. If anyone does any research, you will read about the ability to take elections to reduce this problem. But there's a couple of problems with that. I think All the elections you have to do right at the outset. So if you miss it early on, too late, you have to take your medicine before you resolve it. One called Mark to Market. I don't know. I mean, I can gather from what I'm saying, but the most attractive one is QEF election. This is the one everyone qualifying electing fund or something. QEF election, and it's like, oh, basically you can almost treat it like a regular investment. The problem with that is that requires the PFIC to furnish the investor with a summary, like a 1099 style summary every year, which PFICs don't do. So it's not an option to you.
And plus, you're having to pay the tax on each and every year as if you were selling it at the end of that year.
Yeah.
But the optimization, Richard, is normally in times that are not like we have right now, where we're at all-time highs. A couple of years ago, when the markets were quite low, it was an easier time to say, pull off the Band-Aid, because the markets have one direction to go, which is up.
Wait until the market goes down, selling to try and minimize tax that way.
Well, essentially, if the markets are on all-time highs, you might actually try to balance out your portfolio in certain regards to where, on pullbacks, that becomes the time that you rip the Band-Aid. So near the end of the year, not as easy to optimize. Midway through the year, you might say, when are we going to go ahead and execute on this? Let's go ahead and execute on down days instead of on all-time highs.
So like tax loss harvesting for PFICs.
Could be a nice way to put it. You're turning into the marketing guy, Richard.
My experience has been we've had clients who have done, or I should say more prospects who have done nothing, who have just basically said, "Oh, my accountant says it's fine, so I'm just gonna carry on with that." And I understand that. I think it's dangerous, and because we're talking about a domestic accountant around the corner from them who's no idea what a PFIC is, or FATCA, or 8621s, but they just retreat to, it wasn't a problem before I spoke to you, therefore I'm just going to back away from you. And then we've had other clients who have done exactly what you said, who have ripped the Band-Aid off, who have gone through that process with me on a call, the denial to acceptance, to dealing with it, to paying it, to bringing it to the US, to reinvesting it. It's stressful for a minute, but once they've dealt with it, it's over, it's done, they forget about it, it's invested in the US, they move on, their tax affairs gets more straightforward because they've got fewer international forms. And in my experience, anecdotal as it might be, has always been to those who just deal with it and move on are better for it, both financially and emotionally.
Absolutely. They get to move forward and go on to the next challenge. Like you said, getting a 1099 on your U.S. taxes means your taxes become simple versus doing a PFIC filing every single year. So I'm always a proponent of trying to clean the slate, get into a nice, easy position to make life as good as possible going forward. We've also got to remember, most products in the United States are going to be a lot cheaper than they are going to be on a platform that's going to be a PFIC.
Yeah.
So all of a sudden, when you're buying a general portfolio in the U.S., whether you're on Fidelity, Schwab, Trade PMR, any of these platforms, they're not charging a platform fee. Most every European platform is going to charge some sort of a platform fee. And then the underlying fund management is going to be a lot cheaper on the U.S. side, not to even speak of the trading charges. So
it's a full,
you start to make up for it.
You do. It's a full, 25-30% less investing in the US, isn't it? Maybe even more. It's a lot cheaper.
Depending on the country that you're in, and depending on if it's an insurance product, I see a lot of these insurance products 1.5-2% easily.
Yeah.
And when I look at a financial plan client, going to charge about 1%. And our robo-advisor clients, they're going to charge 0.5%, 0.5%. So it's a huge savings over the course of time that you get to a much better place, and your tax filings are cheaper, your tax filings are easier. So it's the way to go.
Do you have many clients who go through the Streamlined program?
Not as many as I've heard of from other people. Most of our clients, we get them as they're coming over here, especially when they move over to France. Yeah, absolutely. So we have some great partners that help us from the immigration vantage point, and their first thing that they say is, "You've got to go talk to Brian." So we make sure that we're talking to them before they get to France and before they can have any conversations with a French banker. Our tax accountant down in France, the first thing he'll say is the most dangerous person you can talk to is a French banker. Not because they're bad guys, but because they'll try to sell you an assurance vie, which is a PFIC. And I will say there's only one time that I would recommend a PFIC for a client. And that's if they call me and they say, I have weeks to live, and we put 150,000 euros into an assurance vie, and we use a cash-only account so that we avoid some inheritance tax in France. But if they've got any longer to live, there's no sense of ever looking at an assurance vie for an American expat.
That's great though that you're getting these people before they get themselves into any trouble. That's the key. It really is the key. Just if for anyone who's listening, I referenced what's called the Streamlined program, and that's for. So in my experience, unfortunately, we meet people when they've been here a while, and as I said before, if they came here mid-career and they had stuff in their home country, then my anecdotal experience is almost without exception they're in some form of non-compliance. There's unreported gains, income on there, and it might just be, when I say talk about income and gains, it might just be growth from investments. It might be foreign bank interest. Even if there's not that, there's almost certainly some missing FATCA forms, the informational reporting that's required here in the US. And unless someone took specific US, UK cross-border tax advice before they left, which very, very few people do, there's going to be non-compliance in there. And one of the ways that it doesn't really go away, offshore non-compliance. It fades over time, but if these forms are missing, it can leave the statute of limitations open, which hopefully won't be a big deal, but it could be. And some clients, and this is something I completely would understand and gravitate to, want to clear that off. Once they're being made aware that, okay, we've got this problem, I want to move forward correctly, but I don't want this risk hanging over me, however long it might hang over me for. So there's a program you can go through or you can apply to called the Streamlined program. And there's a program for people who live in the US, and there's a program for people who live outside the US, and there's slightly different terms, but broadly very similar. You refile a certain number of tax returns. It's 3 years worth of tax returns, 6 years for FBARs, and you can essentially come in from the cold, and if it's accepted, you can put that risk behind you and move forward, knowing that it shouldn't come back to bite you. So that's what I was referring to there.
It's a great program for people to be able to sleep well at night.
Well, it's also a great program. It's particularly the offshore, the offshore one that I'm sure you're more familiar with because your clients are mostly outside the US. It's a fantastic program, really. It's super generous to solve your historic problems. And I think that's because the IRS has become aware that so much of the American expat community is in non-compliance through no fault of their own, really.
I read that, there's between 7 and 9 million Americans that live abroad. And last year, there were only about 500,000 that actually filed their tax returns. Now, there's some that don't have to file their tax returns.
Did you say 7 to 9 million?
7 to 9 million.
500,000.
500,000 actually filed their tax. Exactly. So I think it's occurred to the IRS that the majority of people are not in compliance. And it's not about going and catching 6.5 to 8.5 million people. It's about trying to get them in the system so that they are compliant, so they don't have to worry about those types of things. If more than 50% of people are breaking a rule, it's not the people that are the problem, it's the rule that's the problem. And it's being in compliance that's the hard part of things. And the streamlined procedure allows people to get back into line and in compliance with the system.
I bang this drum all the time. The most people are in non-compliance, and I bet that's the same for the people we see, expats in the US, and that you see Americans abroad, outside. And to be in non-US compliance is a scary place to be, because the penalties are, even for innocent or non-willful non-compliance, are eye-watering. Obviously, I'm plugged into the UK, and I will see tax advisors and the like lamenting these punitive HMRC penalties that start at £100. I just laugh to myself. They've got no idea. It starts at 10 grand here. What are the chances of you getting tapped on the shoulder? I hope are quite slim. But just having that risk hanging over you is, for most of us, is not a risk we want. It is not a risk we want to deal with. And these two programs present a palatable way to get into compliance. And so I'm always banging the drum. Like, look, if you're an expat here, you're probably in some form of non-compliance, but it's okay. There are solutions, and you should take advantage of them.
Absolutely. I had a client's son who called me today because he got a letter from the IRS saying he owed $240,000. He said,
Ooh.
I'm going to ignore it because I don't even have $240,000, of which I nearly fell out of my chair, saying, no, you cannot ignore this because they will go after everything that you have, even if you don't have as much as is listed on that letter. So it's extremely important. Like you said, 100 pounds, it feels like a lot over here, but it's a joke in comparison to some of these letters that the IRS sends out. And some of them can be mistakes, but it's on us as the citizens to actually correct those mistakes, because otherwise they're just going to compound until they become backbreaking.
Brian, how many people do that? How many people don't have a Brian to call and just, I'm going to ignore this?
I think it's the majority of those American problems that when it comes to taxation, it's just easier to ignore it than it is to sometimes deal with it. The IRS let go of, I can't remember if it was 10,000 employees a couple of years ago. And at first it felt like something to celebrate. And then all of a sudden we figure out these are the people that we're calling to have assistance from. It's so painful not to have enough support from the IRS and to have it all digitized. And that's what it's really turning into. So it's really important to get it right the first time, to get it documented the right way, so that all of a sudden you don't get these crazy letters coming to you.
Do you ever find Americans abroad using one of the more popular DIY tax solutions?
Well, full disclosure, we just put out an article about 6 different providers that include, your low-cost providers like H&R Block and TurboTax, and they do have expat products. And I'm not going to bash them across the board. If you've got a complex situation, it might be tough to use the software. But the majority of people that live abroad, let's just be honest, the majority of people don't have investments, and the majority of people make under the FEIE limits, the foreign earned income exclusion limits. Therefore, a low-cost solution like TurboTax, H&R Block, My Expat Tax, etc., is a wonderful solution. If you have your investment structured in the correct way with the 1099, it can even work. But if all of a sudden you have foreign pensions, if you have PFICs, if you have other complexities, a foreign company or a U.S. company, it's probably tough to use that type of software because you have to have the overarching knowledge of how to use it and to apply it.
They don't even create some of the forms that you need. So we will hear of people who say, I use TurboTax, and you just know it's going to be a horror show, because I know TurboTax doesn't create 3520s and the like, so they're going to be missing. It's really frustrating. And the other thing I'm realizing is the amount of clients who are paying a nominal amount for tax preparation and conflating it with having a tax advisor. And those two things are radically different. If you're paying someone $500 to prepare your tax return, you do not have a tax advisor giving you the ins and outs and providing strategic advice, or even helping you really stay in compliance. They're just box ticking and filling in forms. It's very different.
Absolutely. It is a complexity of some people can't afford it and some people need it. And the number of people that use the proper product is de minimis. The majority of people are actually using the wrong products to get them to the best optimal solution. But in most scenarios, your financial advisor and your tax accountant should be working together towards those
100%.
forward-looking solutions when it comes to tax. And when all of a sudden I get a tax accountant that doesn't want to talk to us, the first thing I'm doing is raising my hand saying, we should be working with a different tax accountant, because the amount of optimization that can be done on taxes going forward with a tax preparer and financial planner together is astronomical. Neither one of us can do it by ourselves.
And we've also got different views. Like, as a financial advisor, we have the 90-foot view and there's like a wide strategic view of where this is heading. The accountant has a much narrower focus, and they miss loads of things. And presumably, vice versa. We've always angled for that. Although it's hard when most clients have tax preparers, not tax advisors. So you have to have a different conversation there. But we're actually about to start, next year, we're going to really start pushing this, because I don't think you can do the job properly, the tax part of the job properly, unless there's an an open relationship there, and you're meeting to talk about this stuff specifically.
Absolutely. I completely agree with you. I mean, if you're back in the States, how do you put together a proper pension for a small business if you don't have the tax advisor working with you? All of a sudden, you're working off estimated numbers instead of the actual numbers. But it's also even just Roth conversions and such. We're definitely playing on that. Pairing those up with a donor advised fund. All of a sudden, if you don't have the tax advisor working alongside with you, your numbers could be way off.
Let's bring it back to PFICs. So we've explained what they are and why US people need to be very, very wary and stay away from them. We've talked about if you have this problem, what steps you can take to resolve it, which really are all quite unpalatable. It's just get rid of them, deal with it, and move on with your life. But let's talk about bigger solutions. So you're an expatriate in America and you want to maintain pounds or euros or Aussie dollars, or you are one of the 7 to 9 million Americans abroad and you want to invest in your home currency, wherever that is. How do you, but you don't want to fall into the PFIC trap. How do you do it?
We have our robo-advisor, which is DF Direct. And we also have all of our portfolios listed through Morningstar, which other financial advisors can access as well as ourselves. And all of our portfolios are going to be listed in dollars, euros, and pounds. We have other currencies, like Australian dollars and such, but they're just not listed publicly. And what this gives us the edge on is the ability to naturally hedge the portfolio. So not only is it going to be represented in those currencies, but we're going to be able to naturally hedge those currencies. We're at a point right now, especially with this last election, the dollar looks like it's going to stay frothy for a period of time, just because there's indications that we might have a little bit more inflation than what we would have expected if Trump wouldn't have won the presidency. So naturally, we haven't moved all of our fixed income out of dollars into euros or pounds because we're on a long-term trend of the dollar going up. But if that turned, we would be able to buy European and UK denominated fixed income inside of that portfolio. Now, that's just for our off-the-shelf product, our robo-advisor DF Direct, or our Morningstar product. But we also have several platforms that if somebody wants to build a custom portfolio, that they can show it in euros, but it's still a US 1099 account. We can buy Euro bonds, we can buy GBP bonds, absolutely no problem.
But just to be clear, Brian, so these PFIC-free portfolios, which are, allow US persons to invest in non-US dollars without falling afoul of the PFIC rules. What are we investing in here? It's direct equity, it's individual equity, stocks and shares, individual corporate bonds, individual treasuries or gilts, whatever we call them out, government bonds. Also US stuff, US ETFs?
We'll have a mix of, we've got to remember that over 50% of the world's market cap is in the US. So if you go under 50% of your portfolio in US dollars, you're underweighting the US, which is a risky proposition to make when most of the performance in the world is coming from AI, cloud computing, all of these sectors that are dominated by the US markets. So we shouldn't be avoiding the US. We just don't want it to be 90, 95% like maybe a US domestic client that's always going to live their life in the US would naturally hedge to the US dollar. We might want to be closer to the 56, 57% that the world market cap, the MSCI Global, represents in the United States. So that's giving us a bigger share. So we definitely want to still own the United States, and we can own that through exchange traded funds that are listed in the US or individual securities. It's the choice of how we want to design that. And that might be for tax reasons. Bigger clients that want to go ahead and manage the taxes a little bit more, we might direct index the S&P 500 so that we can sell off and tax harvest any of the losses. Even in a year like this year, where the markets are up 25%, there's a slew of different stocks in the S&P 500 that are down, opportunities to tax harvest. But if all of a sudden we've got a IRA or such, we definitely just want to buy VU. The Vanguard S&P 500 keeps the cost down. We do the same thing in global markets. We can buy individual securities, individual stocks, or we can buy collectives. In the bond segment, there's not as much choice when it comes to foreign bonds. There's going to be more coming online in the next couple of years, but we most likely have to just buy, for most people's scenarios, individual bonds. So if you have a client lives in the U.S., they're going to move to the U.K. in 3 years. They know they're going to move into the U.K. They don't want to have any currency risk, so they just want to have a portfolio of gilts that are coming due in 3 years to remove that currency risk. We set up a U.S.-based account, but we buy UK gilts in there. Now, we're still receiving our 1099 in the U.S., but we've erased any of our exposure in British pounds. No PFICs, completely PFIC-free portfolio, but a very global portfolio meeting their needs of being able to purchase that house in British pounds.
That sounds like a lot. Like, do you have like minimums for this stuff?
Typically, when we structure a portfolio that's customized, it's anything over $100,000. Anything underneath that is going to be tough to put together because individual securities are going to take up too much of a part of the portfolio. So you're not going to get the diversification that you need. That being said, essentially, if you're building a bond portfolio, you probably want to have $500,000 in there to be able to structure it correctly. Otherwise, you're just buying a simplified off-the-shelf portfolio.
I'm right in thinking as well, you don't need... Is there a minimum for DF Direct?
There is zero minimum on DF Direct, and there's zero commitment. So if you're straight out of college, you're in your first job as a barista, and you want to put away $50 a month, you can go to DF Direct, and you can do so from most any country around the world. No cost to get the money out, no commitments in the longer term, and just 0.5% per year as a management fee.
It's a pretty incredible solution, this. So let me just summarize this for people listening. So if there are a number of ways you can still invest in non-US currencies and avoid the PFIC stuff. It's usually more expensive. There's fewer options. It's a bit more cumbersome. But that's just it just is what it is. And historically, the way we've done that is there are some investment managers, Dunhill Financial is one of them. There are others, LGT Vestra, and they'll manage PFIC-free portfolios, and firms like mine can access them through a platform like Morningstar. So we'll have clients who are definitely going back, who want to keep money in pounds, who want to stay invested in pounds, and they'll utilize these portfolios. Okay, it makes perfect sense. But there's generally, like I say, these are expensive. More expensive than a US equivalent, and you need to put a certain amount of money in for it to make sense. But DF Direct now is like a robo version of PFIC-free investing. So you can be an American anywhere, not anywhere in the world, but in a lot of places, and put any amount in and access PFIC-free portfolios and build up investments in the currency that you're living for, a very reasonable fee.
It's the end of people getting discriminated against for banking as an American expat. That's what it comes
and they get 1099 and all they get all the stuff.
They get their 1099, they get the full reporting, they get their statements. So just like any other brokerage, it's a nice, easy, consistent approach, and we'll be building a lot of advances in it. We'll be receiving and sending out foreign currencies pretty soon. That's our next big upgrade that we're having on the system. So a very easy software, and you can go to dfdirect.com, check out all the portfolios for yourself.
So there are solutions, folks. If you're sat here listening to this and you have PFICs, or you're thinking of coming to the US or leaving the US, and you're wondering how I'm going to invest, there are solutions. It can be done. It's just, as with all things, being an expat in the US or an American abroad, tread carefully. And, of course, find yourself a good team of professional advisors. Right, Brian, thank you for coming on and talking to us about PFICs. Where can people find you?
They can always find us at dunhillfinancial.com or df-direct.com. And you can always email me at brian@dunhillfinancial.com.
Mm-hmm. And, of course, LinkedIn. I don't know if there's a single person in the US or the UK or Europe that I connect to that doesn't already know you. When it pops up, people you already know. So you got there before me. Well, the cross-border space is a small one, but it's a small but a good one. So,
absolutely.
Great, right, Brian. Thanks for coming on.
Richard, always wonderful to see you. Thank you so much for having me.
All right, cheers. See you soon.